Have you ever wondered why Bitcoin can rise 10% one day and fall 15% the next? While the stock market usually moves gradually, cryptocurrencies often experience dramatic price swings in a matter of hours. This phenomenon is called volatility, and it's one of the defining characteristics of the crypto market. But why is crypto so volatile? Let's break it down. First, crypto is still a relatively young asset class. Unlike traditional financial markets that have been around for centuries, cryptocurrencies have only existed for a little over a decade. As a result, the market is still developing, with fewer participants and less liquidity than stocks or bonds. This means that even a large buy or sell order can have a significant impact on prices. Another major reason is market sentiment. Crypto prices are heavily influenced by news, social media, government regulations, and even comments from well-known public figures. Positive announcements, such as the approval of a crypto ETF or major companies adopting blockchain technology, can send prices soaring. On the other hand, negative news like exchange hacks, stricter regulations, or economic uncertainty can trigger sharp declines. Since crypto trades 24 hours a day, 7 days a week, these reactions happen almost instantly. Supply and demand also play a huge role. Take Bitcoin, for example. Its supply is limited to just 21 million coins, making it a scarce digital asset. When demand suddenly increases, prices can rise rapidly because there isn't enough supply to meet that demand. Likewise, when investors rush to sell, prices can fall just as quickly. Leverage is another important factor. Many crypto traders borrow money to increase the size of their trades. While this can amplify profits, it also magnifies losses. When prices move sharply, leveraged positions can be automatically liquidated, causing a chain reaction that pushes prices even higher or lower in a very short time. So, is volatility always a bad thing? Not necessarily. Volatility creates risk, but it also creates opportunity. Traders often benefit from rapid price movements, while long-term investors may see temporary declines as part of the market's natural cycle. Historically, despite experiencing significant ups and downs, major cryptocurrencies like Bitcoin have repeatedly recovered over longer periods, although past performance never guarantees future results. If you're planning to invest in crypto, the key is not to panic during market swings. Experts often recommend investing only what you can afford to lose, diversifying your portfolio, and using strategies like dollar cost averaging, where you invest a fixed amount regularly instead of trying to perfectly time the market. This approach can reduce the emotional stress caused by sudden price fluctuations. In the end, volatility isn't a flaw. It's part of how the cryptocurrency market works. Understanding what drives these price swings can help you make more informed decisions and stay focused on your long-term investment goals instead of reacting to every market movement. If you found this explanation helpful, don't forget to like, share, and subscribe for more easy-to-understand content on cryptocurrency and personal finance. Thanks for watching.